We hear a lot of discussion today about the Fed possibly raising interest rates and what that could possibly do for the bond market. Should you be preparing for a bond market crash, or what is really more important for you to be considering right now? Join us as we talk about this on Consider This Program. Hello and welcome to Consider This Program. I'm your host, Jamie Burton.
And I'm Daren Hardesty.
So glad to have you with us today, Daren. We are going to be talking about some not so exciting topics, but topics that are really important and things that are brought up a lot in today's headlines. We are talking about bonds.
Gotta love it.
Yes. Not super exciting, but a lot of people, when they are putting together their portfolio, they have heard different things. Like if I purchase a zero coupon bond, that's going to be really helpful for my portfolio and for my taxes. Or if I purchase a muni bond, that's going to make sense in what I have going on without really understanding what a municipal bond or a municipal bond or zero coupon bond really is. So we're just kind of going to break that down today. Give some people things to consider when they're trying to make these decisions. So Daren, can you break down for us what is a zero coupon bond?
Sure. So bonds are not the most exciting topic, but something I've learned from working at Financial Enhancement Group that I never would have thought, just because you talk about the stock market all the time and you hear about the stock market, but the bond market is actually 3 times the size of the stock market. There are very, very wealthy people who buy and sell bonds, and it's at different times in history, it's been a very valuable place to put your money, and currently it's just not maybe the best place that makes the most sense for people's money for lots of reasons. There's different types of bonds, but it's important to understand that for a bond, they pay a coupon. So when you purchase a bond, you have a coupon rate, you have a par value. It says clearly what this bond is worth, and then you get paid a coupon based off of that value. And then when you hear about the Fed talking about potentially raising interest rates, what that does to your bond is that it works like a seesaw. If they raise interest rates in the bond that you currently own, as that new interest rate gets raised, now the value of your bond gets less. And it works in reverse. If they lower interest rates, then the value of your bond actually becomes a premium, starts selling at a premium. So interest rates affect what current bond values are. Zero coupon bonds are exactly that. They pay no coupon. And so people wonder, well, if I have a bond is paying me this income, this coupon every month or twice a year, depending on the type. But if it's paying me zero, why would I ever invest in a bond that pays me nothing? And it has to do with how it's traded. So it's not paying you a percentage coupon, but it is trading at a deep discount. So somebody who has a long-term investment that, let's say, hey, over 10 years, I want to have something that I can have at least 6% return on my investment. So let's say you put $25,000 into that. You want to have $25,000 at the end of this road. I have an assumed rate of return of 6%. How much should I pay for this zero coupon bond? So at the end of those 10 years, I get what I need. And you can run a calculation that actually gives you that yield. And so you're going in to buy that zero coupon bond at a discount. You don't get paid anything. But at the end of that road, when it matures, you get that full return. It's a very safe place to be. So it's a risk reward that you're looking at. Zero coupon bonds can be issued by the government. They can be issued by corporations, but they're issued for different reasons. That you do run a risk of a default sometimes because a lot of times a bond, you're paying for a debt obligation. And if they're not having to pay you an income, they may budget poorly and then end up having to default. So you're running that risk. Interest rates may not actually work out the way that you hope that they do over that 10-year period, whatever it may be. But you hear people talk about potentially using this for college savings, laddering these bonds over time. So there's different ways to use them, but a zero coupon bond is exactly what it sounds like. It's you're getting a deep discount to buy it, but you're not getting income while you own it.
Sure. And you said that once this bond gets to maturity, then you get the payout back. How is that taxed? I know taxes is one of the main things that we look at when we're looking at investments and if they make sense.
Sure. So it's a great question, and it's important. I want to make sure I mention too, there's something called phantom income or imputed interest that's inside of a zero coupon bond. So even though you're not receiving income, typically if it's a standard corporate bond or another bond, you're going to have to pay ordinary income tax on that bond income. It's going to get added to your 1040 for that year to be a part of your taxable income. You don't get an actual income, but you actually have to pay tax on something you don't receive. So A lot of times, zero coupon bonds are better off in a tax deferred account where you're not having to recognize that tax. But then at that maturity date, that is, from what I understand, and speak with your tax professional, but at that maturity date, when that money comes through, that is going to be something that's going to be added on. The growth, if you will, is going to be added on to your 1040 for that year.
Sure. So more like a long-term capital gain.
Similar to that. Yes.
Okay.
So you want to make sure that you understand those rules when that does come around. But you do have basis in it. You paid an amount, but you're receiving that extra amount at the end of the 10, 20-year period that when you receive that matured bond.
Very good. And how is the zero coupon bond, how is a municipal bond different from that?
Great question. So municipal bonds, we call them muni bonds. There's different types, but essentially they're set up through municipalities. That's why they're called municipal bonds, meaning your state, your city, your local county. They're going to issue these debt obligations to you so that they can raise money to pay for different projects that they have. There's two different types, main types. There's general obligations, and that is actually paying you from the taxes that are collected from that project that you provided. They're much lower risk, so they're a little bit cheaper in expenses because they're coming from tax revenue. The money that you're receiving, that income, is coming from taxes, which is a much less riskier or less risky move. But then you also have revenue bonds where they're paying you from cash flow that's generated from the project. So imagine, your local county, they want to make a public library. That library may generate revenue somehow or whatever, the project may be, and it's paying you from that revenue. So it's a little bit higher risk because there's not always a guaranteed income. But the same idea works out is that the benefit of them is it works the same way. You're providing money up front so that they can fund their project, but the income that you're generating or that you're receiving is tax-free. On the federal level, and then if it's a project or a municipal bond in your state, it should be tax-free on the state side too. No, not always, but in general they are. So that's the benefit you're looking at. The problem is also that the return on a municipal bond is typically not going to be as high as what you get on a corporate bond. So there's different equations we can use. It's called a tax equivalent yield that you can look at and say, hey, based off your tax rate, you can do a quick tax equivalent yield formulation to say, is this municipal bond worth it being tax-free? Because just because it's tax-free doesn't mean you're going to get the same amount back.
Sure.
Corporate bond may be able to be more valuable even though you're paying tax on the corporate bond's income. So there's different formulations you can do to check to see if that makes sense. Typically, a municipal bond is going to be used with higher income earners for that tax reason. If you're in the 37% tax bracket, paying income on a corporate bond, you might get a great yield from that, but you're going to be paying a lot higher tax rate. The municipal bond taking a little bit less return makes just as much sense knowing that it's going to be a tax-free investment. So it's not always the case, but municipal bonds they definitely play a good part for a lot of portfolios. Just depends on your situation.
Absolutely. So there's really a lot of different decisions that need to be considered when you are deciding if you should be investing in bonds, what are the best bonds to be investing in. And I know that you mentioned earlier when you were talking about bonds and how they function is that interest rates really affect bonds and bond prices. And with the environment that we're in today, with the inflationary environment and with the Fed having meetings about possibly raising interest rates, we have a lot of different headlines coming out about what this could possibly do to the bond market. A lot of them are very dramatic. There are a lot of, we're going to be seeing a bond crash.
Yeah.
How do you see that going forward? And are those headlines really something that should be a big concern?
Well, there's always headline risk. I know Andrew talks about that a lot.
Yeah.
It's a concern, but as far as a crash, no. And there's a couple reasons why. And the Federal Reserve does not come right out and surprise us with a raise of interest rates. They're going to slowly kind of warn us, from the time of this recording, we've been warned for months that they're going to be raising interest rates. And that gives the market in general a time to price itself out and kind of brace itself for impact. And so that alone kind of keeps anything from being a drastic move one way or the other. One of the big reasons people invest in bonds is that they're not volatile. It's if I want to have a 60-40 balanced allocation in my portfolio, 60% equity and 40% fixed income or bonds, a lot of that is just because I don't want to experience a bunch of volatility. Those bonds are there to help prevent those crashes from happening. So when you add in a lot of different things happening in the world, you add in different, headlines, if you will, it's easy for people who don't really know to find a reason to say, I'm worried about this, or that I'm scared, and making a decision out of fear. But in the end, we could see some times where, bonds aren't returning a whole lot, and that's fine. But it's not necessarily something that you should be concerned about. Even if a bond isn't returning enough to keep up with inflation, if the income that, the average income that's being received, it's still okay, again, because it plays a part in diversifying your portfolio. I would encourage everybody, don't be scared of bonds. You want to make sure you understand them. You want to make sure that your financial advisor is keeping up and your investment on your investments to make sure that they're keeping up and making adjustments as needed. That's what we do at Financial Enhancement Group. But at the same time, a crash, probably not. I think just maybe small moves here or there, but a big crash, probably not.
Sure. And the most important thing that you want to make sure you have in place is a process. Why are you making the decisions that you are making? Are you making the decisions based off of emotion because you see this headline on the news? Or are you making an educated decision based on a process that you have in place? That's why we have our investment team in place here at Financial Enhancement Group. They're working based off of a certain process. So they are not seeing that scary headline and making the decisions based off of that. You can visit us on our website at yourlifeafterwork.com to find out more about this, or give us a call at 800-928-4001.